Let's talk about Japan, a country famous for its cutting-edge technology, breathtaking cherry blossoms, and a culture that blends ancient tradition with futuristic innovation. But for decades, Japan's economy has been stuck in slow motion, puzzling economists and policymakers around the world. Japan's economy was like a sleeping Godzilla, massive, powerful, but oddly dormant. The Bank of Japan, or BOJ, tried everything to wake it up, slashing interest rates to zero, then even below zero, launching wave after wave of stimulus, and experimenting with every trick in the central banker's playbook. For years, it seemed like nothing could rouse this economic giant. The goal was simple but stubbornly elusive. Spark just a little inflation, 2%, to get people spending, investing, and believing in growth again. The BOJ hoped that a gentle rise in prices would break the cycle of hesitation and get the economy moving. But for years, nothing worked. Deflation, the persistent fall in prices, kept people from buying, as everyone waited for things to get even cheaper. Businesses hesitated to invest, and the economy barely moved, stuck in a loop of caution and stagnation. Then, the world changed almost overnight. Global supply chains broke down, energy prices soared, and inflation swept across the globe. Suddenly, Japan had more inflation than it bargained for. Prices jumped, and the cost of living started to rise for ordinary people. In 2024, after years of extraordinary measures, the BOJ finally ended its massive stimulus program. By early 2025, it raised interest rates for the first time in ages to a still low 0.5%. It was a historic moment, signaling a new era for Japan's economy. Now, the BOJ faces a new and daunting challenge: how to control this awakened economic giant without causing chaos. Every decision is watched closely, as the risk of moving too fast or too slow could have dramatic consequences. The era of free money is over, and every move the BOJ makes could send shockwaves through Japan's financial system and ripple out to the rest of the world's markets. Today, November 27, 2025, the BOJ stands at a crossroads, holding the remote to its economic monster. The choices it makes now will shape the future for millions of people, both in Japan and beyond. The stakes? Nothing less than the future of Japan's economy, and maybe yours too. As the world watches, Japan's next moves could redefine what's possible for economies everywhere. In this high-stakes moment, voices clash. Some want to slam the brakes on inflation, others urge caution.
Enter Asahi Noguchi, a BOJ board member who's neither a hawk nor a dove. He's the cautious tortoise. Noguchi's mantra, slow and steady, wins the race. He wants to raise rates, but only step by step. He's watching real wages, not just inflation numbers, insisting the economy must prove it can handle higher borrowing costs. For Noguchi, it's about people, not just data, making sure households can actually afford higher prices. As others push for quick action, Noguchi is the voice of calm, urging patience and precision. His call for gradualism is a plea for prudence in a moment of uncertainty.
For decades, a weak yen was Japan's secret weapon, making its exports incredibly competitive on the world stage and powering industrial giants like Toyota, Sony, and countless others. Japanese products became household names across the globe, and the country's economy thrived on this advantage.
But now, that same weak yen has turned into a curse, creating new challenges for businesses and ordinary people alike. Imports, energy, food, and other essentials are now painfully expensive, with prices rising faster than many families can keep up. Japan relies on imports for almost all its energy and much of its food, so when the yen drops, everyone feels the impact at the pump, in the kitchen, and even in daily routines. The weak yen, once a blessing, now fuels inflation and squeezes household budgets, forcing families to make tough choices about spending. Noguchi points out, when the economy is already running hot, a weak yen just makes things worse, adding fuel to the fire of rising prices. With a tight labor market and not enough workers to go around, Japan can't simply ramp up production to offset these higher costs. The yen recently hit a 10-month low, sparking concern and prompting talk of possible government intervention to stabilize the currency. The Bank of Japan faces a tough dilemma: keep interest rates low and risk even more inflation, or raise them and risk slowing the economy or triggering other problems. The weak yen is no longer a simple tool for growth. It's become a double-edged sword, cutting both ways for Japan's economy. What was once Japan's old safety net is now a source of pain, leaving families and businesses searching for new ways to adapt in a rapidly changing world.
Inflation in Japan was once a relic of the past. Now, it's a daily struggle. Consumer inflation has hovered above the BOJ's 2% target for years, driven by soaring import costs.
This isn't healthy, demand-driven inflation. It's the bad kind, where food and energy prices spike. Everyday essentials cost more, but incomes haven't kept up. Households feel the squeeze, cutting back on spending and changing habits. Consumer spending, the engine of Japan's economy, is stalling. Businesses hesitate to invest or hire, creating a vicious cycle. The BOJ's main tool, raising rates, could help, but risks causing new pain. The challenge: fight inflation without crushing growth. Wages are finally rising in Japan, thanks to a tight labor market and union pressure. The annual Shunta wage talks brought the biggest pay hikes in decades, and more are expected. On paper, it's the virtuous cycle: higher wages, more spending, stronger growth. But inflation is outpacing those raises. Real wages, what your paycheck actually buys, are still falling. Noguchi's benchmark for healthy inflation? Real wages must grow by about 1%. He doesn't want to hike rates until wage growth is real and lasting, not just a blip. This wage inflation race is the central drama. If wages win, Japan thrives. If inflation wins, living standards fall. The BOJ's decisions will tip the balance. The stakes: prosperity or stagnation. Even as paychecks rise, the outcome depends on timing and caution.
Imagine Japan's economy as a patient just waking from a 30-year coma. You don't send them running, you start with gentle therapy.
If the BOJ raises rates too fast, it could choke off fragile wage growth and investment. Higher borrowing costs make companies hesitate to expand or hire, stalling the recovery. Households with variable rate loans would see payments jump, squeezing budgets. Zombie companies, kept alive by cheap credit, could collapse, risking a wave of bankruptcies. The doves on the BOJ board fear reversing decades of progress with one wrong move. Noguchi warns, move too fast, and you kill the green shoots of recovery. Gradualism is about nurturing growth, not shocking it. The risk overcorrect, and you trigger a recession.
But moving too slow is just as risky. If the BOJ waits too long, inflation could become permanent, a beast much harder to tame.
A weak yen could spiral, making imports even pricier and fueling more inflation. If people expect prices to keep rising, they demand bigger raises, and businesses pass on costs, creating an inflationary spiral. The longer the BOJ waits, the harsher the medicine will have to be, potentially a deep recession. Noguchi warns, small early hikes are better than drastic action later. The risk of waiting, losing control and becoming a reactive firefighter. The BOJ must act before inflation becomes unstoppable.
So what's the answer? Not too fast, not too slow, just right. Noguchi's Goldilocks approach means tying rate hikes to real progress, especially rising real wages. The BOJ promises, we'll only raise rates when households can handle it. This data-driven, step-by-step plan gives markets and families time to adjust. Small, deliberate hikes, like the expected move to 0.75% by March 2026, send a signal without causing panic. Each pause lets the BOJ assess the impact and avoid derailing recovery. After decades of deflation, Japan is in uncharted territory. Small steps and flexibility aren't weakness, they're wisdom. The goals steer between recession and runaway inflation. It's the only logical path forward.
This isn't just Japan's problem. The decisions made in Tokyo ripple far beyond its borders, affecting people and economies around the globe. For decades, Japan's ultra-low rates fueled global markets through the yen carry trade. Investors borrowed cheaply in yen and invested in higher-yielding assets worldwide, making Japan a silent engine of global finance.
As the BOJ raises rates, that cheap money dries up. The era of easy borrowing in yen could be coming to an end, forcing investors to rethink their strategies. Investors may sell assets worldwide to repay yen loans, shaking global markets. This unwinding can trigger sudden volatility, impacting everything from stocks to currencies.
A sudden rate hike could trigger chaos. Markets hate surprises, and a sharp move by the BOJ could send shockwaves through the financial system. Gradual, well-communicated moves let investors adjust and prevent panic. Transparency and predictability are key to maintaining confidence in uncertain times. The world's financial stability partly depends on the BOJ's careful steps. Every decision is watched closely by markets, governments, and ordinary people alike.
Japan's path is a test case for every modern economy trying to exit zero rates. How Japan manages this transition could set a precedent for others facing similar challenges.
For Japanese families, the stakes are immediate. Rising rates affect mortgages, savings, and the cost of living, making these decisions deeply personal. For the world, it's about financial stability. The interconnectedness of today's markets means that what happens in Japan can quickly spread everywhere. Noguchi's slow, steady approach may not be exciting, but in a fragile world, boring might be best. Sometimes, stability is more valuable than bold moves. Sometimes the safest move is the careful one, especially when the whole world is watching. In global finance, caution can be the wisest strategy of all.